Welcome back to Investing Talk Podcast.
Today we're looking at plug power.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For years, plug power was it was seen by the market as this pure growth story.
Right. High growth, but also really high cash burn.
Exactly. It was a classic high-risk, high-reward bet on the whole green hydrogen future. But what's so fascinating now is that the entire narrative is changing.
How so?
We're seeing what looks like a really critical operational inflection point. The story is shifting away from just growth, and it's moving entirely toward margin expansion.
Okay, that's a huge pivot for a company like this. When you go from growth at any cost to focusing on margins, that signals a real shift in discipline. What was the catalyst?
It was absolutely a targeted decision. The trigger was an extremely aggressive cost-cutting campaign that management kicked off in the first quarter of 2025.
So this wasn't just minor budget cuts.
Not at all. They're projecting that these changes will deliver over $200 million in incremental annualized run rate savings.
Yeah, $200 million. But for listeners who maybe don't live in corporate finance spreadsheets, what does annualized run rate savings actually mean in practice?
That's a great question. It means they've made fundamental changes, like, say, a leaner company structure or better supply contracts. And if you project those savings out over a full year, the total benefit hits that $200 million mark.
Got it. So it's the forward-looking impact.
Exactly. It shows you the new, leaner cost structure they're operating with.
And where did this money come from? Was it all headcount or something deeper?
It was overwhelmingly structural. Yes, organizational realignment was part of it, making the company leaner, but the bulk of it came from really digging into their manufacturing processes and optimizing the supply chain.
Okay, so getting more efficient?
Right. Think about it. When a company scales that fast, the first factories are often built to be quick, not efficient. They went back in and stripped out those inefficiencies before they got baked in as permanent costs.
So they've pulled $200 million in fixed costs out of the system. How does that actually translate into value for an investor?
This is where it gets really powerful. It's all about operating leverage.
Right.
Basically, once your fixed costs are paid for, every new dollar of revenue adds more and more to your profit. Since they've taken so much out of their fixed cost base as revenue scales up, which it has been, those costs get absorbed way faster.
So the profits should grow much faster than revenue now.
That's the thesis. The savings are expected to drive, really material margin expansion. It completely changes the profile of the company.
That makes sense.
Yeah.
But, leverage only works if you have the runway to actually execute the plan. So that brings us to their financial health. How strong is the balance sheet today?
It's improved substantially, and management's shown some real discipline here. As of March 31st, 2025, they had about $296 million in unrestricted cash.
Okay.
But the real vote of confidence came more recently in November 2025. They secured a $371 million convertible senior notes offering.
That's a pretty strong signal from institutional money. But is $371 million really enough to fund something like that huge Louisiana plant?
On its own, maybe not. But that's where the structure of the deal is so interesting. The notes came with these associated warrants.
Ah, okay.
And if those warrants are fully exercised down the line, that could bring in an additional $1.4 billion in capital.
$1.4 billion. Okay,
Yeah.
So institutions aren't just giving them a short-term lifeline. They're underwriting the whole multi-year plan.
Exactly. They are betting on the long-term hydrogen story with plug power as a key player.
Now, one thing that always worries investors in this space is dilution. Issuing more shares to fund the business. Do they do anything to address that?
They did. And it was a really important move. They took one of their existing convertible debentures and they retired about $82.5 million of the principal in cash.
Okay, so they paid down some debt.
Right. But the crucial part isn't just the cash they spent, it's what they eliminated. That single action took approximately 55 million potentially dilutive shares off the table.
55 million shares. That's a huge win for existing shareholders.
It is. It shows they're focused on creating value, not just financing at any cost. And this discipline shows up in their cash usage, too.
How so?
Net cash usage in Q1 2025. It dropped to $142 million. Now, compare that to $268 million in Q1 of the prior year.
That's a massive drop, almost 50%.
A 47% year-over-year improvement. That sharp contraction in their burn rate is maybe the strongest signal you can get that management is credible in executing.
And that kind of improvement must have given them a lot of confidence.
It did. They came out and explicitly stated that the company has, and I'm quoting here, no intention of raising additional equity in 2025.
That's a bold statement in this market.
Very bold. It tells you they believe their current cash plus that financing is enough to get them to profitability without diluting shareholders further.
Okay, so the financial discipline is there.
Yeah.
But let's shift to operational momentum. Cost savings are great, but the business has to actually be growing, right?
Absolutely. The operating leverage thesis falls apart without growth. And the momentum there looks pretty constructive.
What are the numbers telling you?
We've seen a pretty clear sequential acceleration through 2025. Q1 revenue was in the 130 to 134 million range. Then it jumped to 174 million in Q2.
In Q3.
It held strong at 177 million in Q3. So it shows the cost-cutting didn't stall the business. They're actually growing right through this operational turnaround.
So let's talk about their moat, their competitive advantage. As this market grows, more competition is going to show up. What stops them from getting squeezed?
Their moat is really built on this idea of vertical integration. It's quite strategic, actually. They're one of the only players trying to operate across the entire hydrogen value chain.
So break that down. What are the different layers they control?
You can think of it in three big chunks. First, they actually manufacture the electrolyzers. That's the tech that makes the green hydrogen.
Okay, the production hardware.
Second, they handle the fuel delivery and the logistics. And third, they provide the end-use systems, the fuel cells for the forklifts and backup power units.
So they're not just selling a part, they're selling the whole ecosystem. Why is that so important?
Two big reasons. One, it creates massive switching costs. If your whole warehouse runs on their fuel cells and you rely on their delivery network, switching to someone else is a logistical nightmare.
You're locked in.
You're pretty locked in. And two, it lets them capture margin at every single layer. If electrolyzer prices get competitive, they can still make good money on the fuel delivery or the service contracts.
That brings us to their big strategic assets, like the Louisiana plant. How does that fit into this vertical integration strategy?
The Louisiana plant is absolutely fundamental. It is the key to their long-term unit economics. Right now, they still have to buy some hydrogen from third parties, and that's expensive and volatile.
So this plant brings that supply in-house.
Precisely. It's designed to secure their own hydrogen supply at a massive scale. And when you control the supply,
You control the cost.
you control the cost. It lets them aggressively push down their cost per kilogram of hydrogen, which makes their entire offering more competitive and, crucially, more profitable.
It's a compelling turnaround story. But we have to look at the other side. What are the big risks here? What's the bear case?
Well, the number one risk really affects the whole sector, and that's just the uncertainty around market adoption.
So the hydrogen economy itself.
Yeah. I mean, it's still very new. If government incentives slow down or corporations tighten their decarbonization budgets, the adoption rate for everyone could lag, and that would push out Plug Power's path to profitability.
Okay, that's the macro risk. What about a company-specific one?
The second one is execution risk. Scaling these massive, first-of-a-kind industrial projects, it's hard.
Like the Louisiana plant.
Exactly. If that plant ramp-up gets delayed or hits a technical snag, it could increase their cash burn again and really challenge that promise of no more equity raises.
Those are valid risks. But it seems like the financial discipline you mentioned earlier acts as a pretty good buffer.
It absolutely does. That $200 million cost-out program gives them a margin of safety. And the cash position, combined with that 47% reduction in cash burn, gives them a much longer runway to deal with any potential delays. They've bought themselves time.
So if you're watching this story play out,
Yeah.
what are the near-term catalysts to look for over the next, say, 3 to 6 months?
The single biggest one is the Q4 2025 earnings release. That'll probably be late January or early February 2026.
The moment of truth.
It really is. We need to see hard proof that those $200 million in savings are actually flowing through to real, tangible margin expansion in the numbers. An upside surprise on margins would be huge.
And with those earnings will come their guidance for the new year.
Exactly. The 2026 guidance is what will set the tone. We'll be looking for a clear, accelerated timeline to profitability, tied specifically to that Louisiana plant ramp-up.
And you mentioned one other maybe more speculative catalyst.
Yeah. Back in November 2025, they announced a non-binding letter of intent about a potential asset monetization.
So selling off a piece of the business.
Potentially. The details are private, but it suggests they're exploring strategic sales to unlock cash without having to go to the market. If they pull that off, it just makes their balance sheet even stronger.
So to wrap this all up, it really feels like the investment case for Plug Power has, well, it's matured.
I think that's the perfect word for it. They've hit that critical inflection point, moving from a high-burn growth story to a company that's all about financial discipline and margin expansion.
And that shift is being backed by serious institutional money and management actions that directly protect shareholders from dilution.
That's right. The operational turnaround seems to be well underway.
We'd suggest keeping a long-term, multi-year view on the whole hydrogen thesis, but your immediate focus should be locked on those Q4 earnings early next year. That's the key event that will validate this new model. Make sure you subscribe to Investing Talk podcast so you don't miss our analysis when those crucial numbers drop.